Scene script. Have you ever wondered how the rich keep getting richer while the average person struggles to increase their wealth? Welcome to the paradox of wealth accumulation, a puzzle that has intrigued economists and regular folks alike for centuries. The wealthy seem to have a magic touch when it comes to growing their fortunes. But is it really magic, or is it a well-calculated strategy? Let's take a journey into the world of the affluent, where money doesn't just talk, it multiplies. Here, the rules of the game are different. The rich don't play by the same rules that the average person might follow when investing their hard-earned money. While the average person might look for safe, steady returns on their investments, the wealthy often take a different route. They are not afraid to take calculated risks, to invest in opportunities that may seem daunting to the rest of us. They understand that with higher risk comes the potential for higher reward. But it's not just about risk-taking. The rich also have access to a different universe of investment opportunities. While the average person may invest in stocks, bonds, or real estate, the wealthy have the means to invest in private equity, venture capital, and other high-return, high-risk opportunities. These are not typically available to the average investor. What's more, the wealthy approach investing with a long-term perspective. They are not swayed by short-term market fluctuations. Instead, they focus on the potential for long-term growth and wealth accumulation. This different approach to investing, combined with access to a different set of investment opportunities, creates a wealth gap that continues to widen. It's a paradox that seems to defy the basic principles of fairness and equality. But don't despair. Understanding this paradox is the first step to bridging the wealth gap. By learning from the strategies of the wealthy, we can start to level the playing field. Let's dive deeper to understand the investment strategies that the wealthy use to grow their wealth. The investment strategies of the rich and the average person are often worlds apart. Let's delve a bit deeper into this. The average person, when it comes to investing, typically leans towards the more traditional routes. They might be stashing their hard-earned money in a savings account, hoping that the minuscule interest rates will somehow compound into a fortune. Or they might put their money into real estate, buying a house or an apartment, banking on the property value to appreciate over time. Some might even dabble in the stock market, buying shares of companies in the hope of cashing in on a boom. Now, there's nothing inherently wrong with these strategies. They're tried and tested, and they can indeed yield returns. But when compared to the strategies of the rich, they may seem a bit pedestrian. You see, the rich don't just invest. They invest aggressively and strategically. They're not just buying properties. They're investing in real estate ventures, often in prime locations, expecting high rental income and capital appreciation. They're not just buying stocks. They're buying into businesses, becoming part owners, and influencing the direction of the company. They're not just saving. They're putting their money into venture capital, investing in startups, and betting on the next big thing. And then there's the world of hedge funds, a playground for the wealthy, where they pool their resources to make large-scale investments, managed by professionals who employ complex strategies to maximize returns. The rich are also known for their portfolio diversification, spreading their investments across a wide range of assets, thereby minimizing risk and increasing potential returns. These strategies, while requiring a higher level of risk tolerance and financial acumen, often result in significantly higher rates of return, enabling the rich to grow their wealth at a much faster pace. As we can see, the rich and the average person have very different approaches to investing, which results in different outcomes. The rich tend to take calculated risks and make bold moves, while the average person often opts for safer, more familiar investment options. The difference in their strategies is what often separates the rich from the average. One of the key strategies the rich use to grow their wealth is the power of compound interest. Now, what exactly is this compound interest we're talking about? It's interest calculated on the initial principal, which also includes all of the accumulated interest from previous periods. In simpler terms, it's interest on interest. It's like a snowball rolling down a hill, growing larger and faster with each roll. For instance, let's say you have a $1,000 investment with an annual interest rate of 5%. After the first year, you'll have $1,050. Now here's where the magic happens. The following year, the interest is calculated not just on the original $1,000, but also on the $50 gained in the first year. This means you're earning interest on a total of $1,050. Over time, this process repeats and the amount compounds, leading to exponential growth in your investment. This is the secret sauce that the rich use to their advantage. They understand that compound interest is a powerful wealth multiplier. They don't just save their money. They invest it in avenues that offer compound interest. This could be in the form of stocks, bonds, real estate, or even a simple savings account. The key here is patience. Compound interest is not a get-rich-quick scheme. It's a long-term strategy that requires time to work its magic. But given enough time, the results can be astounding. A small sum invested today can grow into a substantial amount in the future, thanks to the power of compound interest. Remember, every dollar invested is a seed. And just like a tree, it takes time for that seed to grow and bear fruit. But once it does, it can provide a steady stream of income for years, even decades to come. In conclusion, compound interest is not just a mathematical concept. It's a fundamental principle that the rich use to build and maintain their wealth. It's a testament to the fact that time, patience, and smart investment strategies can indeed lead to considerable financial growth. The power of compound interest is a potent tool in the arsenal of the wealthy. Scene script. Another crucial factor that differentiates the investment strategies of the rich from the average person is their approach to risk management. So let's dive right into it. You see, the rich don't shy away from risk. Instead, they embrace it. But remember, this isn't reckless gambling we're talking about. It's about taking calculated risks. They invest in opportunities that the average person might consider too risky, like startups, emerging markets, or alternative investments. They know that high risk can lead to high returns, but they also understand that not all risky bets will pay off. And that's where the concept of risk management comes in. Risk management, in essence, is about balancing the potential for gains against the potential for losses. It's about not putting all your eggs in one basket. And this is where diversification plays a crucial role. Diversification is the practice of spreading your investments across various assets or asset classes to reduce exposure to any one particular investment. It's like a safety net that catches you when one or more of your investments take a tumble. The rich understand this well. They don't invest all their money into one business or one stock. They spread it out across a range of investments, from stocks and bonds to real estate and private equity. This way, if one investment goes south, the others can help cushion the blow. But diversification isn't just about reducing risk. It's also about maximizing returns. By investing in a variety of assets, the rich can take advantage of different market trends and opportunities. When one sector or market is down, another might be up. Diversification allows them to ride out the volatility and come out on top. In essence, the rich use risk management strategies to protect their wealth. They take calculated risks, diversify their investments, and keep a close eye on the market. They don't let fear of loss prevent them from seeking out opportunities for high returns. They understand that in the world of investing, risk and reward go hand in hand. The rich use risk management strategies to protect their wealth, while also seeking out opportunities for high returns. So, what can we learn from the investment strategies of the wealthy? Well, quite a lot, as it turns out. Let's summarize the main points about how the affluent invest their money. For starters, they understand the power of compound interest. This is the interest you earn on both your original money and on the interest you've already received. It's like a snowball rolling down a hill, picking up more snow and growing with each revolution. Over time, even modest investments can grow into considerable sums. And the secret? Patience. The wealthy know that true wealth accumulation takes time, and they're willing to wait. Next, they diversify. Rich people rarely put all their eggs in one basket. Instead, they spread their investments across a wide range of assets like stocks, bonds, real estate, and even startups. This way, they reduce the risk of losing money if one asset performs poorly. It's all about balance and spreading the risk. Moreover, they manage risks wisely. The wealthy understand that all investments carry some degree of risk, but rather than avoiding risk altogether, they learn to manage it. They set clear investment goals, thoroughly research their investment options, and regularly review their portfolio. And they're not afraid to ask for professional help when they need it. Lastly, they continuously educate themselves about investing. The wealthy know that the world of investing is always changing, and they strive to stay ahead of the curve. They read, they learn, they network. Knowledge, they understand, is the key to making smart investment decisions. So, how can we apply these strategies? Well, start by understanding the power of compound interest. Then, diversify your investments and learn to manage risk. And never stop learning about the world of investing. While we may not all have the same resources as the rich, understanding and applying their investment strategies can put us on the path to greater wealth and financial security. And remember, every journey starts with a single step. So why not take that step today?